This panel is going to be focused on defined outcome ETFs, and there's certainly a lot that we will want to digest during this panel. And when you look at the growth of the active ETF industry, there's been a tremendous amount of growth, particularly in this segment of the market. And I think it's worth maybe demystifying, what exactly these products are, what they are used for. And I think it's also going to be really important to think about how they impact the market, how clients should be actually thinking about implementing and using them in their overall portfolios. And so we're going to avoid any kind of 101 portions of this panel and really try and make this as useful for everyone here in terms of actual implementation and thinking about how to use this. But perhaps we'll first start. We've got an excellent panel over here of experts, and maybe we'll just kind of go down the row and everyone introduce themselves, and then we'll get things kicked off. So Ian, I'll start with you.
Yeah, so first I want to thank the people of ETF Global for putting this together and Matt for putting the panel together. Ian Van Hoek, I work for Susquehanna. I manage our ETF capital markets and issuer partnerships. So anytime new products are looking at being launched, issuers are giving me a call and we're trying to think, how can we make this work in the ETF wrapper? So I'm excited to dig into what that looks like in this specific space a little bit today.
Yep. Thank you everybody for being here. Brian Bondock, Vega Shares, ETFs. I come from a little bit of a different corner in the sense that, the whole defined outcome ETF space is really structured product payoffs kind of migrating into the ETF wrapper. And for the last 20 plus years, or actually exactly 20 years, I've spent a lot of time on both buy side and sell side, trading, building, and educating clients on structured products. And so, what we're doing at Vega Shares is really trying to bridge that gap and be thoughtful around bringing institutional type strategies into the ETF wrapper.
Ben Fulton, much like what Brian was just talking about, we are involved with using derivatives within portfolios. We're looking more at volatility type management, but I think what we're on is just the eve of derivatives within ETFs. And I think the first derivatives in ETFs was one that I launched 25 years ago. So it's exciting to see this finally come of age, and the scarlet letter of the big D on ETFs is not there. So
this can take a while, huh? Hi, everyone. David Abner. I'm the head of ETFs and funds at Northern Trust Asset Management, division of Northern Trust. I have a little bit of a different take on the defined outcome space, and I would argue that Northern Trust actually brought out the ultimate defined outcome set of ETFs last year, and it's a little bit different than we're probably going to be talking about on the panel, but maybe we'll get there. Thanks.
Well, excellent. Well, now that we've gone through introductions, I guess, David, maybe we'll start with you, just because, thinking in your seat with where you stand, maybe you can talk a little bit about the exact client problem that defined outcome ETFs are trying to solve, whether it's traditional asset allocation, is it solving for low volatility, is it solving for trying to balance portfolios? That's something, you can't do as cleanly with an individual product. How do you think about that?
Yeah, it's a great question. Thanks. So I think the ultimate client problem that we're all about to experience, and it's not necessarily a problem, it's really a wealth transfer issue, right? And it's a good thing because a lot of wealth has been accumulated, and a lot of the holders of that wealth are actually moving from the way I think about it from like an accumulation stage of their life to a decumulation or a money management phase of their life. So I think that if you think about sort of history, right? Mark Andreessen in 2011, he said software is eating the world when he was talking about the growth of what's going to happen over the next 15 years. And I think about that statement a lot with regards to the ETF industry, because I think that ETFs are actually eating asset management. Right, we are going to ETFize everything that needs to be done for investors in not only accumulating and developing and managing their wealth from that they've been earning, but also decumulating their wealth and thinking about using option structures and defined benefits and protecting their wealth for future generations. I think those are the sort of big issues that we're working on as an industry right now.
And so, just to dig a little bit deeper on that, do you think the solution then is, or the value is it in the engineering of the products, or is it in creating a product that allows easier conversations around what it is you talked about, or a combination of both?
I think it's a little bit of a combination of both, and it's primarily using the ETF structure in new and novel ways, right? So I'll give you a quick example just based on what I was talking about in terms of the ultimate defined outcome ETF, right? Last year, Northern Trust launched a suite of what we call distributing ladder ETFs, which are very different than anything that's really been launched in the ETF industry before. And the reason is, nobody ever really wants to launch an ETF that actually winds up in a certain period of time. Yet every ETF we launched 8 products with time frames ranging from 5, 10, 20, and 30 years. They all wind up at the end of their time, right? So if you think about a traditional ladder that you may be building for your clients, that works like you would to manage money, right? Like you buy a ladder each year, that rung matures, and you can go out and spend it. With a traditional ladder ETF, previously, they go on perpetually, and that rung matures, and it buys the next rung. With a distributing ladder ETF, and the reason I call it a defined outcome product is because each time a rung matures, we pay back that return of capital to you. So if you bought a 10-year product, you're going to get 1/10 of your money back, all of it, every year. And at the end of 10 years, the product winds up, right? It's the absolute defined outcome. You know exactly what you get. And as we get deeper into the products where we're going to talk about other types of defined outcome, it gets slightly more murky, but they all have the same concept of giving you ways to sort of manage your money differently.
Yeah, and I think that's a good transition to maybe get Brian involved with structured products, since you've spent a lot of your career and still live kind of in the structured product world. Maybe, Brian, you can talk a little bit about just the buffer and cap concept, why that has resonated so well, and how advisors and clients are implementing them.
Yeah, and I think I alluded to it in my introduction. What we're seeing in the ETF landscape and what we're talking about here is a migration from the structured product payoff into the ETF wrapper. And so this is a combination of derivatives and different payoff structures that really are not new from my background and from some of my co-founders at Vega Shares. These are products and payoffs that we've utilized for decades. And so where I think it gets interesting is when we saw the buffered ETF was the first wave. When we saw that occur, your question is spot on in the sense of like, what is really the driver there? And I think it's a couple of factors that come into play. First and foremost, it's an easy story, right? And so you have a buffered ETF is kind of maybe the introduction of a defined outcome strategy in the sense that it has there's not a lot going on in between the start and the finish of that product. But if you're an advisor and you have clients and you can go to them and say, hey, here's the story, we're going to give you downside, we're going to give you S&P upside exposure, but we're going to give you a hedged equity or downside protection on an S&P, that's a pretty straightforward story to tell. And I think that in itself, when you add in the wrapper of the ETF and you provide scale across a model portfolio, I think that's really what happens. But for me, it's more the behavioral, I think, that ultimately kind of keeps the clients in, right? The story brings them in, but then it's the behavioral of it manages their downside exposure for them in these down markets. And I think that's probably what keeps the dollars a little bit more sticky.
Yeah, and it's a good point because half of the game is staying invested when you don't necessarily want to be or not running for the hills. So I think that's a really important point to make. And Ben, just to turn things to you, when we think about the phrase defined outcome, we obviously use it very, very broadly. There's a lot that can be incorporated into it. How should we think about distinguishing between these caps and buffers and that sort of defined outcome versus more dynamically risk-managed type of products that I would argue also fits into this ecosystem of ETFs and products?
Yeah, no, I'm glad you've expanded the topic to that, love what Dave was talking about. I actually have to,
I'm going to have my own panel.
I actually have to look
find
at your
out.
product. That's interesting. I think the concept, and Eric Backlund has coined this phrase for the buffered ETFs as boomer candy, and I don't think it was totally an accident. I turned 65 later this year, and I have a debate. I don't know why anyone under my age would ever buy a buffered ETF. I'll be blunt. It is primarily, to me, a fixed income replacement tool. It has great features. But what about the millennials and I can't remember all the Gen Zs and whoever? I think there's other attributes of equities, fixed income that need either help or, as I call, a third dimension added to it. And I think that's the beauty of what the structured product world and derivatives bring in. It allows us to take other concerns people may have. Our firm, we've looked at volatility, and volatility is both something that we maybe all cringe at when we hear volatility, but studying volatility, you also see the probabilities increase, and the probabilities are when volatility is low, markets tend to outperform. When volatility is high, markets tend to underperform. So pretty easy trading strategy is volatility when it's low, you want to add more to your portfolio, you want to increase your volatility by adding, and you want to reduce. We do that automatically within an ETF, so it's not a taxable event. We use existing ETFs. I've been in the ETF industry for 30 years. I said, does the world really need more ETFs? And probably a lot of you go, but that's why we're here for. But I'm saying I think some of the ETFs out there needed some help, need some changes, maybe need a different ownership experience as you own them without having to hit the sell button and have a taxable situation or panic because a Trump tweet comes out and you're worried about tariffs. What if the product automatically adjusts according to what the environment? That's one aspect. There's other ways it can be done. But I think any of these type of things try to manage the outcome or the concerns you may have as you sleep at night that you say, if I can address those, wouldn't that help my cause?
Right. Managed outcomes perhaps is better than even just defined outcomes to maybe incorporate the world. And I think we all understand the payoffs and what the outcomes are of these products, but there's a lot that goes into the plumbing of these products. And so, Ian, given where you sit in the derivatives world and trading world, maybe you can talk a little bit about what actually needs to happen from the plumbing perspective to make all of these products work.
Yeah, definitely. So I'm glad you asked the question because I think a lot of times folks just assume something is in an ETF, it magically becomes tradable, tax efficient, and all these things that we associate with the word ETF, but behind the scenes, and particularly when there's derivatives or in a defined outcome portfolio, there's a really big onus on whatever your outcome period is or your rebalance event that you're coordinating with fund managers, market makers, custodians, prime brokers, all to get a specific trade or rebalance done in a tax-efficient manner at a very specific point in time. And that's something that I think is happening behind the scenes and in dealing with all of the issuers out there, I know is not just you launch it, you figure out a workflow, and it goes on forever. It's something that as the fund grows from 5 million to 100 million to $1 billion, it evolves with the fund and with the fund's needs. And it's a conversation we're having every day with our partners. How can we set this all up to scale? And there's been a ton of investment as an industry in setting these things up to scale, automating workflows, OCC talking to NSCC to actually automate clearing of options within the ETF wrapper. And all this work is happening behind the scenes, but to clients and users of the ETFs, it just looks like I bought ETF and it delivered on exactly the investment objective that I was sold on. And I think that's defined outcome ETFs have kind of proved how possible that is with more than just index tracking equities. And everybody up here is thinking, well, there's really great other sorts of outcomes we can provide. And that's what I'm excited to kind of work towards in the next chapter is working with you all. How can we kind of apply the principles we've learned through defined outcome to different asset classes, different payout structures.
And I guess maybe one follow-up question to that, given the rising complexity of some of these products, where are maybe some of the breakpoints or issues that could exist where we are today? And based on where we're seeing growth in all of these products, what do you think is maybe too nascent, or where do you think more investment has to be done before we can really see proliferation of more products that push boundaries?
Yeah, that's another great question. I think that a lot of folks look at, oh, this defined outcome, put spread collar percent threshold has been really successful. I want to expand it to another outlier. One thing that I think is just a fundamental hurdle that you can't really invest in to overcome is just the underlying liquidity is ultimately what drives the ETF liquidity. So like S&P 500, NASDAQ 100 have very robust volatility markets to them, and that's why those ETFs are so liquid. It's not just because they were put into an ETF that those flex options become liquid. On the other side of the coin, I think things that we actually can work on as an industry to make it more scalable and expand it out to lots of things that do have that liquid volatility market or liquid underlying and make sense in client portfolios as a sort of defined outcome-like strategy would be really consistency and uniformity in the data going on, being passed back and forth between fund managers, their custodians, market makers, and kind of putting those things into, like I said earlier, we've invested a lot into scaling just the existing suites that are out there. If something new comes along, you can kind of set it up to look a lot like what's already out there, and folks will be able to flip a switch and turn it on next day versus starting something from scratch when there's been a lot of work already done in this space that you could leverage if you just kind of do some tweaks and are engaging all the partners within the ecosystem involved earlier on.
Well, perfect. And maybe we can dive a little bit deeper now in terms of what's changing and really where a lot of the innovation actually sits at. And Brian, we talked a little bit about the growth of structured products and kind of the intersection of structured products and ETFs. As you look at all the different, variations, whether it's reverse convertibles, auto-callables, et cetera, which one of these do you think translates best into the ETF wrapper right now?
Yeah, I think that's a great question. When there is a conversion that's happening, right? And this is a start, as I mentioned before. The first wave is the buffered ETF space, and we're starting to see another phase kind of coming through. And so the way I think about it is, not every payoff is going to translate. I know that sounds kind of obvious, but there will be a natural tendency for issuers to kind of take what we're doing in the note world and bringing it into the ETF wrapper. And just kind of like what you're saying is just assuming that you put it into an ETF wrapper, it's just that much better. There are a lot of benefits that we can unlock taking a structured product and payoff and putting it into an ETF wrapper. But for example, starts with buffers. Auto calls probably are next. Where does it go? I mean, that's really what we're asking here. You have dual directionals. You have shark fins. You have Himalayas. You have birthday cakes. You've got twin win, Asianing, averaging, cliquet. These are not your Instagram tags. These are actual payoffs from a structured product space. And so I kind of over-exaggerate a little bit, but these are real. And please, somebody hashtag birthday cake on their Instagram. But I think the tell will be you have to be thoughtful around the payoff, and it's obviously the world of structured investments is about tilting the odds in the favor of your client, right? We want to optimize the probability of your client getting that defined outcome, if that's what we're going to call it, right? And so I think the tell will be, if you look at buffered ETFs, you have a start and a finish, right? It's a very simplistic payoff. It's a call spread or a call option with a downside put. Easy to manage, probably something that you can easily put into an ETF. Now let's go to an auto call, which is where I think the next wave is going to occur, and what we're seeing and what we're doing at Vega is we're bringing out auto call ETFs. It's a lot more complex, right? It's a completely different axis. It's a different engineering problem. And so you have, in between your start to finish, You have observation dates. You have, it could terminate early. So you could have forced reinvestment. You have to then redeploy it in a current market. There are a number of factors that come into play. So it's a quite different and a very much more complex engineering problem. And so we have been very thoughtful about how we implement this, and then most importantly, the partners that we implement this with, right? So there are only a handful of banks that actually can affect this and do it in the right way, in the most efficient way for investors. So I think it's going to be, in a short answer there, I think if you're managing a vintage and you can't drop it into a model portfolio, then it's going to be a tactical idea at best, and it probably won't survive. But if you can layer it across a continuous payoff, and you can deliver it to a client, and most importantly, you can educate them on it, then it most definitely survives.
Well, perfect. And David, to then think about portfolio construction. So we have all of these products. Where do these fit into from a portfolio construction perspective? Is it best sourced from equities, from fixed income? Does this fit into an alternatives bucket? How should investors think about where to fit these ETFs from a risk budget?
Yeah, it's really interesting. They were talking about that this morning as well a little bit. And this morning they had said it comes from the equity side of the portfolio. But I actually think, look, right now we're talking about, I don't know, maybe $100 billion in assets across all of these ETFs, which with ETFs at 15 trillion, it becomes like the fingernail, right? And yet they get, I don't know, 80% of the press coverage. So where they fit within the portfolio is still a TBD, right? Because some people are using them as core replacements, and I think that's probably what Vega would want you to think about, where to put their products and others, right? And some of them are thinking of them as a satellite, as a piece of sort of a way to protect that sits around the edges, right? To think about your core, and then you can protect it with something sitting alongside of it. That's the way they would think about it. So they aren't taking away from your core equity or core fixed income, but they're fitting it into that alt sleeve and thinking about it there. So I think it's a little bit about, it's like this debate between active and passive. There's no real answer yet as to where these things are going to sit and how they fit.
Perfect. And Ian, I know we talked a little bit about the plumbing that goes into all of this, but right now, I guess, at what point does product growth become large enough? So like David said, still fairly small. It's a rounding error with respect to the total ETF landscape. But when does growth become large enough where it starts to affect critical issues like liquidity in the overall market?
Yeah, another great question. So I think that one thing that's great about ETFs is it's pretty obvious to look at a chart and see as the assets grow. It doesn't usually happen overnight. And the underlying liquidity in the defined outcome strategies that we know well, like if you had told folks it would be a $100 billion kind of asset class or suite within ETFs when they were first coming out, they would say that the market wasn't ready to absorb that. But the market grew and liquidity providers got ready and prime brokers were ready to facilitate kind of the size as it grew over time. And so I have confidence in our industry, not just ETFs, but financial industry overall, to kind of rise to meet those demands as assets grow kind of at a pace that is reasonable. On the other side, I think that just the sheer number of products that are out there means that the sheer number of trades that have to get processed on any given day or on month end or quarter end, it's already a bottleneck, and it's already a pressure point that a lot of folks are trying to solve for. And I think remains to be seen exactly what shape that's going to take. But I think if we were to take on, not just us, but as an industry, double the amount of products, there's no way we could process it all, price back every single trade. Fund managers could actually agree to a price on every single trade with the time crunch that they have to deal with right now. So it's going to take a different shape, I think, in the future.
Perfect. And to build on that, Ben, do you think, given the growth of all these products and all the different, variations of structures that Brian pointed out, is there a risk that we're trying to overpromise precision with respect to all of the outcomes we have, as opposed to what you talked about earlier, just getting people in for a smoother ride? And I guess, how do you think about, how the conversation has to evolve, and/or product innovation has to evolve to really get to, I think, that latter point?
Yeah, I'm not sure we're maybe over speaking on the precision. I mean, it's pretty structural. Whether it's the buffer or someday we have principal protected or whatever. But I'm not sure we've really educated the marketplace on what their ownership experience is going to be like. I mean, it's pretty easy to see with the buffered ETFs that are out there. They do exactly what they're supposed to do, but it's sounds like the extension of the fixed income series we had before, but it's a little better than the risk-free rate. It's not like you're going to you give up something. The more precise a number you want, you give up something. So at some point that either means a cap, something rigid. The more flexibility you have, now you can have a little more room to move. So what does the client want? What do they have? And some of it also is how long is their time horizon? And I think that's the problem I have. If we peg these around baby boomers only, I hope I have a lot of time. But the timing becomes more shorter. But I think the use of what these products, they should be used in UGMAs and other, and be a better target date type product as they're built over longer periods of time. So I think there's a lot of work that needs to be done that it goes into. And then the environment on the outside, would principal protected sell right now? Maybe not, but you get some shaky markets and some things, not a spaceship. Like if you haven't looked at the chart of the last 3 months, it's pretty crazy what's happened in this market. But this isn't a market that a lot of people are worried about, or they've been rewarded just holding on to investments. You change that environment and we'll all have a different thought of, what can Vegas share, or Webb's, or Northern, or Ian might go back to a person he said no to before. Say yes to me, Ian. And Ian, and then build other products. That would be, the timing would be right.
Can I jump in for one?
Please.
I was just listening to what you guys are saying. I think and the question, I think the only thing we can almost say with certainty is that we've reached like the sort of death of the 60-40, right? Like, we're moving to a period where and we can do it systematically, where you can build bespoke portfolios for almost every investor, right? And we do it a lot. We have a $1 trillion wealth business, and it's almost entirely bespoke, everything we're doing for all of investors, right? We start with this goals-based framework, and then we build portfolios for them, right? And I think ETFs and the continued development of what we're seeing in the ETF space, each of these sort of scalpel-like instruments is going to enable us to build these portfolios that will really be tailored for each individual, right? We're moving far away from 60-40. That's like a land lost long ago kind of thing.
No, I'm glad you said that, because I would fully agree, and I think we need to separate the discussion of the death of 60-40 from the death of diversification, because I think those are two very, very different connotations. Because you can be diversified, you can get to the risk goal you want, you can just do it in a very different way than 60-40. So that's a really, really good point. And just to stick with you, David, for a second, because as you think about building these portfolios, obviously due diligence has to be conducted on these. And given where you sit within a large wealth platform, what are some of the most important metrics that you look at from a due diligence perspective? Is it looking at the caps, the buffers, kind of the exact specifications of the ETF's liquidity? How do you think about what makes the cut for people to be able to use?
ETFs are interesting, right? I think that when you're thinking about ETFs and how do you think about due diligence on them, what I see most in the industry is that people need to see that the ETF does what it says on the tin, right? And when we get into these complicated products, that's sort of the benchmark, right? So if you think about pick a pick a, DRAM, right? It was able to grow to become the fastest growing ETF ever launched because it's super simple to understand from day one, right? When you think about a distributing ladder ETF, like what we launched last year, you're not going to get quick growth out of those because the thing that people are waiting first and foremost is, are you going to make the payout are you giving us back one sliver of our capital next year when you say it's going to pay out, right? And with the buffers, the interesting part about this growth to me and what we've seen over the last 5 years with the growth of structures and options funds is it has all been in one raging bull market, right? None of them are battle tested at all. And I think that's going to be a critical piece of due diligence, which will work in our favor in the end, right? We're going to get a down market eventually. We're going to see some tough times. And then the products that really perform, that will lead to our next leg up in terms of growth of this set of products.
Yeah.
And if I may, I agree with that. And what I would say specifically is, if you look across the structured space, a lot of these strategies we have been deploying, and investors, albeit institutional and ultra high net worth, have been deploying for years. And so they have seen the COVIDs of the recent history and some of those drawdowns. But the ETF buyer historically has, whether it be through access or friction, they have not experienced those payoffs in those down markets. So we have to do a very good job of educating them on what that expectation and how it should perform. As Ben was mentioning, that the products perform the way they should, but we need to make sure that they understand that.
Right. And
I think there was a discussion before this morning about on the high income panel about costs, which I think is going to play into this too. Investors just don't understand what the benefit. They understand what the theoretical benefits are, but the costs are only going to come out when markets move a little bit, right? When there's an increase in volatility and we see ups and downs. And I think we just haven't seen any of that yet.
yeah, all good points. And Brian, maybe just to dig a little bit deeper, because I think I'd like to use the remaining time just to speak specifically about innovation and where we think we're going to see the most future innovation going forward in the space. As you look at demand for whether it's retirement income, downside risk budgeting, tax-aware implementation, is there any specific outcome that you think is rising to the top of where the next wave of innovation is? Or do you think there's anything that we're missing right now that we still need to think about as an industry to bring to market?
Yeah, it's a good question. And when I think about it, the first thing that comes to mind, and maybe this is because we just launched our product and it's an income product, is really retirement income. But I would also, as I'm thinking about it, it's not because of the normal reasons that most people would probably state, and that being, it is a contributing factor, demographic change and baby boomers, and I think that plays into it. But I also think it's actually to what David was spot on in saying that if you look, the 60-40 portfolio is, whether it's the portfolio itself or the income that people are thinking about, that old model, that old engine is broken, right? And we could go back to 2022 when was the most recent example of, a period where we realized that bonds and stocks, they don't always operate the way you think that they're going to. They can both go down. And then also your income and how that can fluctuate and volatility, how all of this plays together. So I don't think demand is going to be the only driver of innovation. It's going to be a factor for sure, but there's probably two factors, especially when we look at this next wave of auto call ETFs. One of them is going to be tax implementation, tax efficiency, and then I think it goes back to being able to allocate it within a model portfolio, right? And I made the comment before, if you can't take this payoff and drop it into a model portfolio, it's going to be hard to scale. And so what we're providing, and I think what innovation is going to provide, it's taking the friction points from the structured note world, eliminating that, or reducing it to almost none, and providing access to those institutional strategies in a more tax efficient, operationally efficient, and model portfolio example. And so one example of this is if we can deliver a baby boomer income, but we don't have to, the income doesn't bleed ordinary rate, and we can recharacterize that, I think that's a very, very big value proposition. I think those are a couple main factors that are going to drive innovation, and then collaboration with and feedback from clients to the issuers like Vega Shares.
Perfect. And Ben, maybe just to dig a little bit deeper as well, because we've talked a lot about, I'd say a little bit more equity focused, but what about, the next stage of development that has multi-asset underlying? So thinking about equities and or fixed income or just non-equity underliers, global equity type buffers. How do you think the future looks for those products? Are we ready? Is there demand for that?
Yeah, I don't know if there's demand today, but I think, if I go out many years ago, I was a CTA, a commodity trading advisor, probably before most people knew what a CTA was. Maybe they still don't know what they are. I look and go, usually commodity waves go like 10-year cycles, and we're kind of early in it. I do look and go, one of my COO sitting back here, he created the first Deutsche Bank commodity products, and those are pretty simple products. In some ways, they're the only products that are still out there, but maybe there is a lot of work that needs to be done, because the same features you have in structured products, you can do there. As I say, I think a lot of answers can happen, and to me, the best goals are, what can we do to keep investors invested? Because the worst thing I think it happens is when people try to come out of the market, guess what's going on, miss, frustrated, pay taxes, come back in. But if you can keep people invested, diversification, kill the 60-40. I like to say that we can make T-shirts about this. But I think this idea of teaching that diversification, where does that do? But I think there needs to be broader diversification across more asset classes. Good, bad is, the dollar is, we're having I think there was a tug of war a year ago or so when was Bitcoin going to become the new global currency as gold, but now the dollar's come back in reigning, and it's kind of put the foreign markets on hold, but for sure that's going to play into. And I think the good news is innovators up here, that's our job, is to keep innovating and keep looking, or hit the on button when the time's right. So the good news is we have a lot more things in our toolbox to work with and hopefully provide better products.
Yeah, and Ian, as you kind of sit at the intersection of enabling this growth, as you think about where innovation lies, what about innovation in your space? I think where are you seeing the most innovation taking place that will enable the next generation of these defined outcome ETFs?
Yeah, definitely. So I think, maybe 2 years ago, we were Susquehanna, as the largest options market making firm in the US, couldn't really figure out single stock options within the ETF wrapper. Today, it's totally normal, something we are more than comfortable pricing and ready to support that area of growth within the ETF wrapper. And part of that was just rising to meet the demand of what the world was expressing with their wallets, what they wanted. And I'm personally really excited for. I think the point of diversification is great, because a lot of folks are overweight the S&P 500, and you think of that as a diversified thing, but maybe they are far more overweight NVIDIA than they want to be. And I think the next wave we'll see is, the defined outcome funds out there, they act very passive index-like, and exactly how they're going to behave, but I think there's a lot of room for just more active management with a stock basket or fixed income basket, and using options or derivatives to just complement or say, this specific risk I want to manage or mitigate. And I feel that we have done a lot of work to actually leverage the pricing engines that Susquehanna has across the globe and just across our firm here in the United States, and figure out how can we port this all to live in one risk book here in the ETF wrapper. And so I think just we're in a very good spot as an industry to react to whatever the thing is that clients are demanding, and bring new products in a very short amount of turnaround time, and the liquidity will be there. But exactly what that is, I wish I could know. But
Can I jump in 1 second on that question? You sort of asked Ben about this sort of the expansion of the asset class, right? And we had the fixed income panel before, and like the ETF industry is kind of funny. It's the reverse of the world, right? The world in the real world, fixed income dwarfs equities. In ETFs, equities dwarf fixed income, right? And when you think of sort of death of the 60-40, I think a lot of these products become sort of fixed income replacements, because the fixed income market really hasn't. It's almost like the fixed income market has refused automation in many ways. They're still behind. They're still opaque. And the ETF industry said, kind of screw it. We'll just create new versions of fixed income using structured products, and buffers will be the new buffer type products, or defined income will be the new fixed income type of vehicle, right? Until they catch up. I think that's kind of happening too, which is, I don't know, maybe it's just starting to become apparent.
Perfect. And I think with the time that we have left before we open it up to questions from everyone, I think we can do our own little lightning round as well. And, maybe we'll target keeping our responses to 30, 45 seconds or so, but feel free to chime in with if anyone has anything to add. But perhaps we'll start off just maybe one myth about defined income ETFs that you want to retire today.
Defined income or defined outcome?
Whichever, or even just the name itself.
It's not boomer candy. It might be Gen Z matcha or millennial single malt, something.
I got a myth. I don't think, I do not think these are easy to understand products, right? I think that's the myth, that you can launch them and that they're easily understood and digested. I think that's not true. We've got to do a much better job as an industry educating about how to use these products. I'd love to see an independent source talking about the different types of products and comparing them. In some ways, you can go to the issuer websites, but most of that is marketing drivel. But if you go to you go to Reddit, you get real deep analysis on some of this stuff, right? Like, we as an industry need to be providing some of this deep competitive analysis to educate investors. I think we're not doing a good enough job yet. I think that's a myth.
I think a carryover from the note world, you hear this often, is too good to be true, which has an undertone of, just because we give you a defined outcome does not mean that you are going to get that outcome. And there are trade-offs, right? So your max return is a max return. That doesn't mean you're going to get the max return. It's just saying that if the market goes up and it goes down, what's going to happen during that period. So it goes back to the education. Education is key.
Great. Next question, which will be super simple. The client type that this is most useful for and also most inappropriate for.
Most useful is, I think, longer-term, longer-oriented investors that want to stay in the market. Most inappropriate, somebody who's just holding cash and they prefer to hold cash, or CDs.
Yeah, I think building on that, I don't see most of these products playing great for the trading type of firms. There might be some short trades, but I think there's other products that are more suited for that. The longer tenure you have, I think the more opportunities you have.
Perfect. And then the last question before we open it up, one innovation that you think will matter the most over the next 3 years.
Well, look, I think the money market business has grown tremendously right now, and I think distributing ladders are a replacement for cash holdings and money market funds. So I think that's going to be a tremendous innovation that people don't understand yet. So I'm going to bet on myself on that one.
I think we're going to have to innovate if conflict in Iran goes away, we return to declining interest rates, because that usually has some funding effects on products like this, and we haven't been in a really super low interest rate environment. I'm not predicting we're going there, but if we do, you may see some changes just because the environment changed and the funding will change. So we may have to, relook at what some of these look like.
I'm going to take David's advice and bet on ourselves. I think what you're going to see is what we've already done, which is we've instituted some mechanisms that are, again, not taking exactly from the structural world and bringing it into the ETF, but being thoughtful about it. So, we have a mechanism, it's adaptive vol. I'll let you guys go through it, but thoughtfulness around the exposure, right? Taking that continuous payoff across multiple vintages and creating that exposure, but doing it tax efficient and thinking about tax wrap. I think that's the true innovation that we're seeing right now and we will see.
I think that just the direction the ETF industry is heading, the menu of options and funds that are out there for folks to manage is probably overwhelming. And their model portfolios have been incredibly successful because that was our industry's kind of answer to that problem. But I think we're going to see that get even more customizable, where you can just plug in, this is my portfolio, and it can tell you a much better sense of, like, here's how you can hedge your specific risks given your liquidity events in the future, whatever that timeline is. And everybody will be kind of involved in how do we service that and solve for that. But yeah, it seems kind of inevitable just with the sheer amount of product and different asset classes that are making their way into our industry.
Well, perfect. We've got probably time for 2 or 3 questions. So I know we covered a lot of ground, so please,
Hey, thank you very much. Yeah, I was just wondering, what does, with these types of products, what does advisor education currently look like? And what do you think needs to change about it to get them more on board and adopting these types of products? Thank you.
I mean, I'll chime in. I think the advisor education is, obviously, it's the most important, and a lot of it is through various forms of interactions. It could be in person, one-on-one, could be through webinars. We also try to put out, and we're being thoughtful around the content, the materials, both in written and video form, that we want to put out. And I think it's not too dissimilar from the approach that we used when we were going back to the structured products world.
In our case, because what we're doing is very rules-based and we're looking at daily, but we still went through and created indices on them, so we give you 20-plus years of history. We go old school. We still provide INAVs because these products are hard for people. I mean, try being a private credit fund today and have an INAV. It's a little tough, but in our world, we can provide an INAV, tell you exactly what the NAV is every 15 seconds during the day, so at least you know if the bid offers are right. So some of it's foundational back to beginning of ETFs, but then moving forward, a lot of it is understanding some of these studies we've done around probabilities and volatility, and how volatility affects a portfolio, and when it's worked and when it hasn't. Because I think that's one of the beauties ETFs have always had, is the transparency aspect.
I think advisor education is about to change dramatically, right? The reality is advisors can't understand or intake the amount of ETFs and the amount of the nuance required to understand the detail in these ETFs. I think AI is about to change all of that, right? So AI, the adoption of AI tools by advisors is rampant right now, and they're going to be using AI tools to sort of create portfolios and screen the industry, and it will be able to decipher these payouts better and suggest portfolios easier for advisors. And then we'll be able to tailor the education based around that sort of narrowing of the funnel for them. I think this whole thing is about to change quickly.
Dave, I think you might have answered my questions, but I'll still go with it with more specifics. We know that the ETF business is about 15 trillion, as you said. Defined outcomes are currently at 100 billion. We know the structured product business in 2025 did about 250 billion. So it's obviously lagging in terms of, it's still evolving. Like you guys mentioned again and again, education's key. But what would you think is the 3 things that would be a prime factor, somebody who buys structured products, the 250 billion annually, that they should be looking at this new version of ETFs? Obviously education is one, but if y'all can maybe highlight a few points that anyone who is looking at structured products, what is the benefit of having a defined outcome ETF?
Well, I think it's slightly different. I think defined outcome products are sold. That 250 billion that you're talking about, those are sold products, and really the amount of ETF people that are selling defined outcome ETFs right now they're dwarfed by traditional defined outcome sales, structured product salespeople. So I think as this army of people changes, as Goldman puts 1,000 people to selling, their innovator ETFs and stuff like that, it's going to dwarf the industry. That's where the growth is going to come from.
I think the one thing is that I won't say all advisors, but a lot of advisors kind of want the easy button on a product that is out there. So the the person in the neighboring cubicle in the neighboring office may have been using structured products, they may have heard it, but the adoption across advisors' use of structured products or investors' use is pretty low. I think simplifying it, putting it into an ETF may bring people that say, hey, I know that's been good for the person next door. I can now participate because it's easy and it fits within. And we saw this like when I launched the first factor ETFs 15 years ago or whatever. No one thought low vol. It took me 2 years to get an index provider to build me a low vol index, let alone did anyone understand the benefit. And then overnight, factors now are like household terms. And you're like, yeah, sometimes it has to come to the point. It will not shock me that trillions come into this space just because the adoption, structured product world's done a great job, but it's been hand-to-hand combat. Let's be serious. Now all of a sudden you get a chance for more. Do you like that?
Yeah, I thought it was great. I think I would sum it up, because I know that the red light's flashing at me. I would sum it up as access, scale, and then efficiency, tax efficiency. And so you can provide you the same payoff that you may or may not have been using in structured products or had access to, but now you can access it more efficiently and scalable in an ETF.
Well, perfect. I'd like to thank everyone in the audience for your attention, and especially to our great expert panel. Really appreciate your time and insights, so thank you.